you're curious about which ETF is better, Vanguard Total Stock Market ETF, VTI, or Vanguard S&P 500 ETF, VOO. In today's video, we'll dive deep into the similarities and differences between these two popular Vanguard ETFs. By the end, you will have a clearer understanding of which one aligns better with your investment goals. Both VTI and VOO are products of Vanguard, a giant in the investment world, managing an astonishing $8.1 trillion in assets as of December 2022. So what sets them apart? Let's start by understanding what VTI is. VTI, the Vanguard Total Stock Market ETF, offers a broad exposure to the US stock market. It includes large, mid, and small cap stocks across various sectors led by technology and consumer discretionary. This ETF tracks the CRSP US Total Stock Market Index, which consists of over 3,800 individual stocks, essentially close to 100% of all investable US stocks on the New York Stock Exchange and NASDAQ. With this level of diversification, VTI gives investors a comprehensive view of the entire US market. Now let's look at VOO. VOO, or the Vanguard S&P 500 ETF, tracks the S&P 500 index. This index is made up of large cap stocks from the US, and around 1/3 of the ETF's 506 stocks are tech companies. Both VTI and VOO gives exposure to the tech sector, but there are key differences in how they approach the market. In terms of similarities, both VTI and VOO are passively managed ETFs, meaning they don't require active management and therefore come with low expense ratios of just 0.03%. Both funds have a minimum investment of just $1, making them highly accessible. VTI tracks the CRSP US Total Market Index, while VOO focuses on the S&P 500. And when it comes to sector exposure, both ETFs are heavily weighted in technology stocks. VTI has 30.1% of its portfolio in tech, while VOO has 28.1%. Additionally, their healthcare and financial sector allocations are nearly identical. VTI holds 12.6% in healthcare and 10.5% in financials, while VOO has 13.1% in healthcare and 12.6% in financials. But there are also some important differences. VTI offers much broader market exposure with its 3,861 stocks compared to VOO's 506 stocks. This means VTI gives you access to a wider range of companies, including small and mid-cap stocks, whereas VOO is more concentrated on large-cap companies. In terms of share price, as of August 18, 2023, VOO was priced $400.92 per share, almost double VTI's. VTI is $216.96. Now let's talk about performance. VTI has a 10-year average annual return of 12.07%, while VOO slightly edges out with 12.61% return over the same period. Despite the differences in the number of stocks, VOO still performs slightly better than VTI. Why? This could be due to VOO's focused exposure on large cap companies that tend to dominate the US market. When we look at dividend yield, both ETFs are very similar, with VTI yielding 1.42% and VOO slightly higher than 1.45% as of July 31st, 2023. If you're an investor who relies on dividends, there isn't much of a difference between the two in this regard. Another aspect to consider is the trading volume. VOO has a 50-day average trading volume of 3.94 million, while VTI has a slightly lower volume at 2.94 million. This higher trading volume for VOO indicates greater liquidity, meaning it could be easier to buy and sell VOO shares more frequently without affecting the market price as much as it might with VTI. VTI also has greater exposure to the consumer discretionary sector. As of July 2023, 14.4% of its portfolio is made up of consumer discretionary stocks, compared to just 10.6% for VOO. This means VTI leans a bit more heavily on companies like Amazon and Tesla, which are considered discretionary. Now let's talk about the pros and cons of each ETF. VTI's broad exposure to nearly the entire US stock market is a significant advantage. You're getting exposure to both large, established companies as well as smaller, more volatile ones. However, with that comes more complexity. 3,800 stocks in your portfolio can make it harder to track performance. Also, VTI is heavily weighted towards the tech sector, which could be a downside if you're looking for more diversification. On the other hand, VOO focuses strictly on the 500 largest companies in the US, making it less diversified but more concentrated in market-leading companies. The downside is that VOO has a heavy reliance on just 3 stocks: Apple, Microsoft, and Amazon, making up a large portion of the portfolio. This concentration could be a risk if one of these giants underperform. So who should buy VTI? If you are an investor looking for broad exposure to the US stock market with a mix of small, mid, and large cap stocks, you want a low-cost ETF. VTI could be a great choice. The fund's low expense ratio combined with an attractive 10-year average return makes it appealing. However, if you're looking for simplicity and don't want to deal with thousands of stocks in your portfolio, VTI might feel overwhelming. Who should buy VOO? If you want to focus on large cap stocks and have a bit more confidence in the US economy's biggest players, VOO might be a better fit for you. Its performance over the last decade has been slightly better than VTI, and it carries a same low expense ratio. However, its heavy concentration in tech stocks like Apple, Microsoft, and Amazon could be a double-edged sword if these companies start to falter. Both VTI and VOO are excellent choices for investors offering low-cost exposure to the US stock market. The decision really comes down how much diversification you want and your outlook on large cap versus total market exposure. Stay tuned for more comparisons like this on our channel. Till then, goodbye.